Hi, I'm Will from Unleashed, and in this video we're going to look at the difference between perpetual and periodic inventory management. Now, the difference between these two methods describes how we account for our stock on the balance sheet. This is really focusing on how we purchase our stock. When we purchase our stock under a periodic method, we're going to recognize that as a purchase, and only on a periodic basis we're going to do a journal to update our balance sheet to the correct amount of stock we have on hand. Whereas under a perpetual inventory system, when we purchase our stock, we're going to recognize that on the balance sheet as stock on hand and only recognize our expense on the profit and loss when we sell our stock. So there are more journals involved in a perpetual system than in a periodic system, which is why if you're running a paper or a manual based system, you generally tend towards a periodic system. But if you do have a system in place such as Unleashed, it is much preferred to run a perpetual system because you're going to get a much accurate representation of the profit and loss and the balance sheet. So what I want to take you through here is the journal so we can understand what it looks like when we're buying and selling stock under both methods. And finally, we'll look at the journals when we do our end of year reconciliations. So let's jump in and we'll check it out. So let's start by looking at periodic stock. So what I'm going to take you through here is looking at the journals when we're purchasing and selling stock. Then we'll look at the profit and loss at the year end and then see what journals we need to put through to get our stock on hand accurate on the balance sheet. So let's start with our purchases. So when we purchase stock, we're going to recognize a debit to our purchase account, which is on the profit and loss, and then a credit to our bank account, which is on the balance sheet. So we've reduced our bank account by $500 and recognized a purchase which sits on the profit and loss. When we sell stock, we're going to recognize an increase in our bank account, which is $900 on the balance sheet, and then a credit to our revenue, which is $900 on the profit and loss. So very basic purchase and sales journals. Now, let's look at the profit and loss at the year end. So this is assuming we've got a whole year of trading here. So our trading income, which is our sales revenue, is $861,560, which is the total amount of our trading income. Let's our cost of sales, which is our purchases. So we've purchased $361,890. So it's a total cost of sales, which gives us a gross profit. Now, this is not correct because we haven't got an opening and closing stock journal on here. So let's go put this through now. So at the end of the year, we need to ask our client, what is your closing stock figure? They advise us that it is $274,100. So we put through a end of year journal for this client. So the end of year journal, well, first we need to debit their closing stock. Now their closing stock should be the current stock on hand. So at the end of their financial year, that would be, of the previous financial year, that is going to be the stock on hand that's still sitting on the balance sheet. So the first thing we want to do is take the stock on hand out of the balance sheet. So this journal here will leave us with zero stock on hand on the balance sheet. So then we need to journal in our new stock on hand, which the client has just given us, which was $274,100. So we debit in the stock on hand. So now we have the correct stock on hand on the balance sheet, and then we put in our closing stock. So these journals here will give us an opening and closing stock journal and also update the balance sheet to be the current stock on hand, which is $274,100. So let's look at how this looks once we've put our journal through. So we've got our trading income, which hasn't changed. We've got less cost of sales, which is our opening stock on hand. Our purchases, less our closing stock on hand, which updates, that gives us our total cost of sales, which gives us our updated gross profit, which is very different to what we saw in the other example. So in our other example, we're showing purchases, which is our cost of sales, at $361,890, but now we have our total cost of sales down at $299,730, which updates our gross profit by the difference between those two amounts. So we've gone from around about $490,000 up to $561,000. So a really big jump in our gross profit, and that's because we've put through that closing stock on hand journal. Now let's look at perpetual stock. So under perpetual stock, when we buy stock, rather than going to the purchase account on the profit and loss, this goes to the balance sheet as stock on hand. Then we have a debit to our bank account. Then when we sell stock, same as before, we had the bank account, which increases by $900. We recognize our revenue, but this is where things get a little bit different. We have another journal here to recognize the cost of goods sold. And then we also credit the stock on hand. So this is why there are more journals involved in a perpetual system than in a periodic system. But the benefit is we're perpetually going to have an up-to-date profit and loss and balance sheet. But as we saw in the previous example, both the profit and loss and the balance sheet are not up to date until we put through that opening and closing stock journal. Great, so then we do our end of year questionnaire. So what is your closing stock figure? The same as our previous example. Then what we want to do is check there are no draft accounts payable and receivables. And that's because we may have journals that have come through from Unleashed that are sitting in drafts. We want to make sure those are approved. So let's look at the profit and loss. So we've got our trading income, same as our other example. The cost of sales will already be accurate, and the reason for that is because we're running a perpetual system here. So the gross profit is consistent. Now, we do have an optional end of year journal to put through under the perpetual method. Let me take you through that. So we've got our end of year journal, you got your opening stock, and then you debit the cost of goods sold, and then you've got your debit the cost of goods sold, and then put through your closing stock. So what you'll notice here is there's actually no journals that impact the balance sheet. All of these here are sitting in our cost of goods sold. Opening stock, cost of goods sold, and closing stock are all sitting in the same part of our profit and loss under the cost of goods sold, which gives it a net effect of 0. So if you now look at our profit and loss, after putting through that formatting journal, we've got our sales revenue, which hasn't changed. We've now got an opening stock on hand, we've got our cost of goods sold, and our closing stock on hand. So our cost of sales has not changed, giving us the exact same gross profit. Now let's look at the profit and loss with a formatting journal and without a formatting journal. So this profit and loss here is without the formatting journal. So you see the cost of sales is $299,730, giving us a gross profit of $561,830. Now once we have done our formatting journal, you'll notice that the total cost of sales has not changed and the gross profit has not changed. All we've done is we've entered an opening stock on hand and a closing stock on hand, which updates our total cost of goods sold, which will align it with what was actually in our periodic system, giving us the profit and loss being, our gross profit being completely the same. So I hope that clarifies things around the difference between the perpetual and the periodic method. Under the periodic method, we're only going to periodically have an accurate profit and loss and balance sheet because of how we're recognizing those sales. They're not actually going to the balance sheet, so we're having to do a journal to align the balance sheet and also update the profit and loss. Under the perpetual system, however, we're perpetually going to have an accurate profit and loss and balance sheet, which allows us to run reports throughout the month or throughout the year, and we're getting accurate information to make decisions. So I hope that was useful, and I'll see you in the next video.